Hi, everyone. Thank you for joining today's webinar, Physician Reimbursement and Investment Planning During These Turbulent Times. Today's program will be presented by Tom Farrell, Principal in Withum Wealth Management, and Maureen Doherty, Manager of Withum's Healthcare Advisory Team. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen and will be distributed to you after the program. Also, at the bottom of the toolbar, you will see a questions box. Feel free to send us your questions during the presentation. We will do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I will turn it over to Tom.
Thank you, Rachel. So good afternoon. My name is Tom Farrell. I'm a wealth advisor and portfolio manager here at Withum Wealth Management. So I wanted to begin today with a brief presentation on the following topics. So the impact of the Federal Reserve policy on financial markets, the relationship between bond prices and yields, higher yields and retirement plan design, and then finally stock valuations, diversification, and staying invested. So the most important financial topic this year has really been inflation. Running at over 8% annualized for most of the year, the Federal Reserve has had to quickly tighten monetary policy to help fight inflation and its impact on the economy. So the Fed solution has been to increase rates via a mechanism known as the Fed funds rate. It's really one of their only tools they have. So the impact of rising interest rates has made waves throughout the global economy. We're not the only country with inflation issues, and it's really had an impact on financial markets all across the globe. So I think it'd be helpful to provide a brief history of recent Fed monetary policy to help paint a picture. So the so-called Great Financial Crisis, if we go back to 2008, 2009, really ushered in an era of low interest rates that we've all become used to over the last decade plus. And this easy money policy stance from our Fed was one of the factors that helped fuel one of the longest bull markets we've seen in history. So the US economy recovered slowly out of the Great Financial Crisis. It took years for us to get back to normal. And the Fed left rates at basically zero for many, many years. They finally started raising rates at the end of 2015, beginning of 2016, and gradually raised rates over the next 3 years or so. So at that point, the Fed, wasn't really worried about, an overheating economy. They just wanted to kind of get back to normal. This was a normalizing interest rate policy stance. And the Fed, kept rates around, I want to say about 2% or so. They did cut back a little bit in 2019, but for the most part, between 2016 and the beginning of 2019, the Fed funds rate was about 2%. So this is still a pretty accommodative stance from the Fed, and the markets continued to really grind higher. And they kept those rates kind of where they were until we saw the next big impact, which is when the COVID-19 pandemic exploded in the beginning of 2020. And what did the Fed do at that point? Well, they slashed rates back to zero, and we had a whole bunch of fiscal stimulus to help support the economy. So consequently, over this time period, going back to 2008, 2009, the S&P 500 increased over 400% between March of 2009 and February of 2020. So the old market adage of TINA, that stood for there is no alternative, really what it meant was, from an investor standpoint, the only place to be was owning stocks, right? There was really no yield elsewhere to be had, and if you wanted to get ahead, you needed to own stocks. So here's what that performance of the S&P 500 looked like in a graph over that time period. So the market collapses in the fall of 2008. I'll hover my mouse over that particular area. Fed slashes rates around here. And then the market starts to recover. And what we saw was the recovery continued to last and last and last over that 10+ year period. the Fed did raise interest rates a little bit. There's that 2016 through 2019 period, but the market continued to grind higher over that time period. And then we got to that peak in February of 2020 before the pandemic hit. And then the market really collapsed at the beginning of the pandemic. And what the Fed did was they came in here and they slashed rates again. And then we saw a really rapid recovery back up through the end of 2021. So this is a graph of the Fed funds rate dating back about 10 years. So you can see that the years where the Fed kept rates near zero, the left-hand side of the graph, coming out of the great financial crisis, that was a long period of time. And then this is the period where they started raising rates, and it looks like a staircase. This is the gradual increase from the Fed over that 3-year period. And the rates only got back up to about 2 to 2.5% or so. So not too restrictive. Then here's where they started to cut rates when the pandemic hit. They slashed them back to zero. And then what I really want to bring your attention to is the right-hand side of this page. This is 2022. This is now the Fed coming back to the market, realizing that inflation was not a transitory type of an issue. It was something that was deeply embedded here in our economy and in other economies around the world. And they've been increasing rates, and they've done so at a very aggressive pace. In fact, the most aggressive pace we've seen since 1994. And this line really just kind of goes up almost in vertical fashion this year. So quite a significant move. Do we have our poll question now, or is that after this one, Rachel?
After this one.
Okay. All right, so let me sum this up. So take a look at the difference in yield at the end of 2021 to October 31st of 2022 for the 3-month US T-bill, the 2-year US Treasury note, and the 10-year US Treasury note. It's really a night and day comparison. Certainly for shorter term treasuries, the 3 and the 2-year, rates were below 1% at the end of last year, and now all these rates are above 4%. Now, I know it's a little bit hard to see, but at the bottom of the page here, we're showing you what the S&P 500 has done over the same time period. So far, the first 10 months of 2022, the S&P 500 has lost almost 19% of its value. And at some points during the year, it was even lower than that. So in terms of the impact here of Fed monetary policy, the rapid increase in interest rates has made investors really think about this equation between risky assets versus less risky assets. Less risky, I'll define as more of your bond and your fixed income investments. If I can get 4% now on high credit quality fixed income, that makes me think twice about what I'm paying in the stock market. I think now it's time for our first poll question.
Yep. So our first polling question, as interest rates rise, what happens to bond prices? Reminder to get your votes in order to get CPE credit. Leave it open for about 30 more seconds. All right, 10 more seconds and I'll close it out. All right, I will close it, and here are the results.
All right. Yeah, so bond prices decreased. That's the right answer. So let me get to my next slide. So I like to show this this seesaw graphic. If I can, let me just here we go. Okay, so one of the main financial issues in 2022 is really highlighted in this relationship between bond prices and bond yields. And there is this inverse relationship between the two. So as rates rise, bond prices fall, and vice versa. As rates fall, bond prices increase. Now let's go through an example. So let's suppose that investor A owns a bond yielding 2% a year. And let's say the price for that bond is $100. Now let's suppose that interest rates rise from 2% to 3%. So investors A's bonds is now, it's not as attractive because now new bonds are hitting the market at 3%, and I'm sitting here owning a bond that's paying 2%. So the bond price would decrease accordingly to adjust for investor demand. If I was a buyer of that 2% bond, I wouldn't want to pay you $100. I might offer you something like $97. I need to be compensated for the fact that the yield on your bond is now less than what I'm seeing in the general marketplace. So the financial media have really brought to attention to this classic 60-40 investor portfolio. That's a portfolio consisting of 60% stocks, 40% bonds. This has long been considered a moderate portfolio allocation with a combination of growth and stability for investors. 2022 has been, a really challenging year when it comes to stocks and bonds. It's a rare year where we see both stocks and bonds down for the year. So we've already covered the fact that the S&P is down almost 19%. But at the same time, the Bloomberg US Aggregate Bond Index has lost almost 16% of its value over the first 10 months of the year. So there's really been no shelter from the storm, as they say, for bond investors. You would typically look for that fixed income portfolio to really help buoy the returns of your portfolio. But because we've been in this rapidly rising interest rate environment, even our bonds are down so far this year. So one of the benefits of higher interest rates, if we switch gears a little bit here, is some creative retirement plan design. So for example, a cash balance plan is a defined benefit plan that can really be a good fit for smaller, profitable physician practices. Annual contributions for cash balance plans are significantly higher than 401k plans, and they're 100% funded by the employer. No employees make any contributions to cash balance plans. So investment policy for cash balance plans is centered around this unique investment crediting rate. So contributions they earn a crediting rate that are typically in line with a benchmark, and typically a benchmark we see for cash balance plans is tied to something like the 30-year U.S. Treasury. And if that was my bogey in terms of what I'm crediting participants in a cash balance plan, over the last 10 years or so, it's been harder to find investments that are providing a return that are in line with what that 30-year was yielding. Fast forward to today, though, now based on my previous slide, even for a 3-month U.S. Treasury bill, I can get over 4%. So when it comes to investment strategy and investment policy for a retirement plan like a cash balance that really focuses on this crediting rate, now I can reduce the overall risk of my portfolio and rely on high quality, higher yielding fixed income right from the U.S. Treasury. So it's really been a game changer for those types of plans. And the last thing you want to do with a cash balance plan is really introduce too much volatility. So switching gears, I want to talk about equity valuations. One way to evaluate the stock market or even individual stocks is to look at valuations. One of those key metrics would be your price to earnings ratio, which is simply the price of a stock divided by its earnings per share. So the higher the PE ratio, the more expensive the stock or the market, and the lower the PE ratio, the less expensive, right? So vice versa. So to put it another way, the PE represents how much an investor is willing to pay for $1 of earnings. So the S&P, as of the end of October of this year, was trading at a PE ratio of a little over 16.5 times earnings. Now, if we compare this to the 25-year average for the S&P, it's pretty much right in line with that average, which is about 16.8%. Now, to show this graphically, we think this is a pretty good visual. I know it's a little bit small here, but This graph goes back to the dot-com bubble burst of the late 1990s, early 2000s. The low point of this graph is the 2008-2009 Great Financial Crisis. And these dotted lines that you see here represent either the average for the PE ratio for the S&P, or these one standard deviation moves above or below. So you can see that this spike in PE ratio for the S&P was towards the end of 2021. Fast forward to this year, we've seen a big drop off in the market, and therefore you would expect to see valuations become cheaper, which they have. So, at one point they dipped below 16, they were around 15 times earnings, but now they've kind of inched back up a little bit, and again, showing that the market right now, as defined by the S&P 500, is pretty fairly valued. So let me just, I'm sorry, I skipped one slide there. So just a final word on valuations is, at this point, there's still a whole lot more that the Fed is telling the market that they're going to do in terms of interest rate policy. They're likely going to keep hiking from here. So valuations could become more attractive from this particular point in time. And they really shouldn't be used as a trading mechanism. We think valuations is a good data point when it comes to evaluating either the stock market or any individual holdings. And it gives us at least some information about whether that part of the market or that particular security is expensive, cheap, or fairly valued. But it should just be one of the things that we use as we evaluate investment policy. And let me go back, Rachel, one second. Here we go, right here. Sorry about that. So it's really important to remind ourselves that market volatility is normal, completely normal. It's really what we do during volatility that matters the most. We all learned, a long time ago when we first started investing that, we should be buying low and selling high. But typically what we see is, investing is emotional. And a lot of times investors sell when the market's down, right? Because it's painful. And they buy when the market is up, right? They buy after they see that, things are looking pretty good. And that's really the opposite of this buy low, sell high investment adage. So we have our next polling question.
All right, our second polling question. What is the average intra-year decline in the S&P 500 dating back to 1980? All right, get your votes in. I'll leave it open for about 30 more seconds. All right, 4 more seconds, I'll close it out. All right, and here are the results.
Okay, well, thank you, Rachel. So I see most are -5%, followed by, let's see, -7%. So the correct answer is actually -14%. Which, is eye-opening. These next two charts I'm going to show you are charts that I love when it comes to, just thinking about market perspective and what happens in a given year. So this is a chart that goes back and looks at the S&P 500 all the way back to 1980. And 32 out of those 42 years, you can see that the market is up. That's over 75% of the time. But on average, in any intra-year period, right, the market has seen a peak to trough decline of 14%, even if the market ends up positive for the year. So, it's easy to lose sight of this when just looking at calendar year returns. But for example, take a look at 2020. That's this one right here, where you see this -34%. So this is what happened initially right after the pandemic hit. The market lost about a third of its value in about 20 trading days, right? That's a huge movement in a short period of time, but the market that year ended up double digits. The S&P was up over 16% that year. So, if you found yourself panicking during the down, part of the market in March and April of 2020, you could have sold and really locked in those losses. But I think this chart does a great job of saying, hey, if we own stocks, we're going to go through, even during a 12-month period, some highs and some lows. But for the most part, the market does end up higher over time. And of course, you'll see years like 2008, 2018, where the market was down, pretty significantly and still finished down for the year. And the next chart is just one final note on staying in the market. Just jump right back to that real quick here. So this graph, I think, does a great job of showing average returns for an all stock portfolio, that's the green, an all bond portfolio, that's the blue, and a 50-50 mix of stocks and bonds, that's the gray. And it's showing the returns over different time periods going back to 1950. So these are rolling from left to right, rolling 1 year, 5 year, 10 year, and 20 year periods. As you can see, time horizon matters. Certainly in any one given year, we can see a wide range of returns. And if I own stocks, yes, I would expect to have years where we could lose a whole lot in 1 year period, or we can gain a whole lot in a 1 year period. But if my time horizon starts to move out to 5 years and 10 years and even to 20 years, you can see that the chances of having a negative rolling period of returns gets smaller and smaller. And certainly in the 20 year, there's not a negative rolling 20 year period to be found going back to 1950. And it can be hard to kind of wrap our heads around a 20 year time period, but if you just think about life expectancy and the fact that we're investing over the course of our life expectancy, we can help kind of keep that in perspective. And then finally, just some notes about being diversified. So, what is diversification? It's really owning different types of investment assets with different risk return patterns to help spread that risk of the portfolio, okay? So 2022, yeah, it's been a year where most financial assets are down, but returns have varied quite significantly. And the one outlier this year happens to be energy. Energy is the best performing sector so far in 2022. I wanted to show you a chart of what different markets have done this year. So if we define the market broadly speaking as the S&P, that's down about 19%. If I own the Dow, for example, I cut my losses in half. If I own the tech-heavy NASDAQ, I would have lost 30% so far. These returns are through the end of October of this year, right, year to date. International stocks, that's the MSCI EFA, they've lost more than the S&P, about 23%. Small caps have held up a little bit better, about 14%. Here's that energy sector return, just blew everything out of the water. It's up 67% year to date so far this year. Healthcare has been very defensive. It's down less than 5%. Commodities, this is a basket of things like food, energy, precious, and industrial metals. That's up over 14% so far this year. And then from a style perspective, value has really outperformed growth. And that's, think about companies that can pay dividends, companies with better balance sheets that have the ability to kind of pass on these higher prices to consumers. They've held up a whole lot better so far in 2022. And it's really about, trying to protect that downside, right? The greater the loss, the harder it is to break even. In this example, on the left-hand side, we're saying if I lose 25% of my investment, then I need a 33% return just to get back to even, right? And if I own something that lost 50%, then I need a 100% return just to get back to even. So trying to, diversify a portfolio can help hopefully lessen the downturn in a portfolio. And then, just to sum up here, I'd say that, portfolios that are heavy in tech, growth, consumer discretionary, even international, really have suffered the most in 2022. If you were able to mix in some other asset classes and styles like value or energy, small cap, and healthcare, you would have improved your returns so far this year, having a more diversified approach. And then finally, even on the fixed income side, swapping out of things like bond funds to buying U.S. Treasuries, recognizing the big movement in yields can really help reduce risk and help with that cash flow. So in summary, the Fed monetary policy really does have a significant effect on financial markets. So it really pays to to know how it impacts us. Rising rates have forced bond prices down, so bond investors really need to pay attention. Higher interest rates can help with retirement plan design and cash flow, like we talked about. Stock valuations, the good news is valuations are cheaper today. So, that's a good thing if we were thinking about future returns, but we'll see some more movement in where valuations are. And then finally, time in the market and being diversified really matters more than timing the market. So that's my time. I appreciate it. Thank you.
Good afternoon, everybody. My name is Maureen Doherty, and I'm going to be talking about maximizing revenue in the physician sector. So as we know, healthcare providers have been facing some of the toughest revenue challenges in the past couple of years. Reimbursements have declined over the last few years. Compliance rules have changed. High deductible plans have increased. Many physician practices are still short-staffed after the pandemic, and coding and documentation audits have increased. And we'll go further into the coding and documentation in a next couple slides. But since the audits have increased, there's a lot of times money is being paid back to the insurance companies, and that has caused a lot of issues as far as the revenue in the practice. So all these areas have squeezed the practice's operating margins. And the key is for the practice to evaluate your revenue cycle process and determine how to manage these areas. Right, so everything starts with the new patient, so best practices approach for the new patients are always to give a new patient welcome packet, just so that it explains it's a welcome to the practice, an overview of the practice, what they can expect. But the key piece of it here is the financial policies document that goes to the patient as well. All the payments that are due at time of service should be the copay, coinsurance, deductible, and past due balances. So practices that are verifying benefits prior to the patient coming in should know if the patient has a coinsurance or a deductible that is still due, that you can collect that money from. And any past due balances that the patient has had before should be collected also and this should all be done prior to the patient seeing the physician. Also, a telehealth visit policy should be provided. And that policy is going to clarify that the telehealth visits are actual billed visits with the doctor, nurse practitioner, or a physician assistant. And I say that because there have been many instances where patients have had telehealth visits and thought it was just as if they were talking to the doctor on the phone about an issue they had, and that they were not going to be responsible for payment. So it's very important to make sure that they are aware of that information. And copays for the telehealth visit need to be paid prior to the visit being initiated. So that would be done up front, then they would be connected with the provider and be able to have their telehealth visit. Payment options for patients should be all major credit cards and debit cards, cash, check, an online patient portal where they can make payments, which is also very helpful. Down the line, should they get statements, they would be able to go on to that patient portal and pay their amount that is due. I can't talk, sorry. And credit card on file. I find that a lot of practices do not have credit card on file, but it's a very good idea to have. So this way, as the patient comes in, if there are any patient balances, you can ask the patient, we have this credit card on file for you. Can we please put the charges on there? I find it in other practices, but not, and I'm saying that, I'm going to say, like, I know the veterinarian I go to, they have credit card on file, and it's seamless, to pay the balance that's due, And then anything, if you had an outstanding balance, you could pay that as well. But I really truly have not seen much of it in physicians' offices as of yet. And also a payment plan policy. Should you have a practice that procedures are done, and there are a lot of times that some of the procedures are not paid in full, or the patient has a higher amount that they would have due for it, you could do a payment plan policy with automatic monthly payments. So you set that up so that once you have that arrangement with the patient, every month their credit card would be billed. Financial hardship policy for people who obviously have issues paying in general, you know, what you can do to work that hardship out with them as far as getting some money back financially. No-show policy and charges, so no-show fees if the patient does not show up to their appointment. Self-pay visits and/or procedures policy, again, self-pay, or if there is a procedure, they have to generally pay in advance at the time of service, unless they have made other arrangements as far as a payment plan, if they don't have the funds to do it upfront. And there should always be a guarantor's agreement, which is a guarantee of payment and assignment of benefits. Okay, so we're going to go through the revenue cycle here. So we're going to start with the front desk. Accurate demographics is key in a medical practice. You have to make certain that all that demographic information is input correctly, that the patient's name, the date of birth, the patient's ID number all need to be accurate. If not, the claim is going to get rejected once it goes out. And it's just taking more time if that should happen. It's taking more time from your billing staff to work the rejections, and in sense that is costing you money as well, okay? So also coordination of benefits, that's a big rejection. Many times the responsible party or subscriber or someone other than the patient. So it could be a parent, it could be a spouse. So you have to be certain who the responsible subscriber is for the insurance. Insurance verification eligibility, very, very important as well. It's crucial to ensure that the patients are enrolled in their insurance and that they understand their plan details. And again, if they don't and they give you incorrect information, the first pass claims rejections, that's where it's costing you money. It is costing you money for there. All right. Point of service collections, we just touched on in the previous slides, but just collecting up front avoids sending out invoices, so you're not chasing down that patient who has 10 patient statements and you're still not getting paid. Managing collections or writing off to bad debt. So collecting up front has decreased those areas quite a bit. All right, coding and documentation. So providers and staff should be educated annually of the new codes and changes that go into effect, which is January 1st. However, the list of the new revised and deleted codes are published every October. So every October, every practice should have a staff person who goes through those revisions so that your system is updated properly for the new year. So for 2023, there are 225 new CPT codes, 75 deletions, and 93 revisions of a code. There's 25 deleted codes and many revision codes to guidelines in 5 categories, which I want to go over because a lot of practices where these revisions and deleted codes are, the practice utilizes. So medical decision making, as of last year, the coding levels are now determined by medical decision making or time. Medical decision making tables have been revised in which acuity or chronicity rather than quantity. So you need to review those tables prior to January, because that's going to be your key as to how you're going to get paid. All right. So if you're not using time most practices I see that since that went into effect last year are basing their codes on the medical decision making. So it's very important that you check into that. All right. The additional categories are hospital observation, consultations, the nursing facilities, domiciliary, home resident services, and prolonged services. The consultations and hospital observation, I would say, are the two key ones here for a medical practice, and especially if you have patients that you are hospitalized in observation, you should look at those, and the same as with the consultations.
All right, on to our third polling question. When are past due patient balances collected? I'll leave it up for 30 more seconds. Remember to get your votes in. All right, I'll go ahead and close it out. And here are the results.
That's correct. The 80% during the check-in process is the correct answer. Okay, continuing coding and documentation. What I've seen through the many years I've been consulting in coding and documentation, there's either great documentation or no documentation. There seems to be none in between. It's all over the place with that. So things that you need to look at, the biggest coding issues are insufficient documentation, but that goes along with the bullet of incorrect coding of E&M services to support medical necessity and accurate billing of the E&M services. Those are the two biggest areas where audits occur. Insufficient documentation if you're not completing everything that's required in your note, but also the coding level, and that is the key. And I have heard many different things from providers through the years when there's an audit taking place. You know, I work hard, and so I deserve to get paid higher. Well, that's true, but you have to have the documentation that supports that. I had another physician who, it was right when EMRs had first come out, and she was being audited by an insurance company. And I started going through her EMR, and I thought, these are like the best notes ever. Like, I don't understand why they are auditing her. And then I looked at the bottom, and it had the time spent with the patient, 60 minutes. Well, it was 60 minutes for every patient, and she saw 20 patients in a day. So she had to pay a tremendous amount of money back to the insurance company. So those are things that you have to be aware of, especially with EMRs, that making sure that and now that you can bill for time, as long as you're not going over what you work in a work day. No documentation, I have seen that in the past. I have to say now with EMRs, I don't see that too often. No physician signature, this is a very interesting one, because most EMRs and everything sign the notes, right? It says it's electronically signed. I have seen audits where they have denied for the signature may be there, but it has to state the date and time that that signature was put on that claim. So that's another one for there. And no modifiers or incorrect modifiers. 57 modifiers and 59 modifiers. So 57 modifiers, I'm sorry, 25 modifier and 59 modifiers. 25 modifiers means that it's an additional service to the practice. And the 57 is differentiating a procedure. Those two are the biggest areas of audits as well. So between the modifiers and the incorrect coding of the services to support the medical necessity and accurate billing of the codes are the two biggest areas where a practice would get flagged for an audit. And once you get into an audit, it's very difficult to get out. A lot of times practices need legal representation. Sometimes it could just take working with the insurance company and making sure that all the physicians or providers are educated in coding so that they can code the correct things. When you're educating them, you may review codes, review charts to be able to tell them also these are the areas where you're lacking and that you need to correct this. And it doesn't matter if you had 10 physicians and it was 2 physicians who were not coding properly, the whole practice is responsible for that. And so practices should consider having annual coding audits and education so that they can catch any errors and recapture and rectify any mistakes resulting in increased revenue, which will result in increased revenue and compliant revenue. All right, insurance contracts and fee schedules. Your fee schedules and your contracts are your main revenue source. Fee schedules should be reviewed before renewing your contract with your insurance. Most insurances renew every 3 years. Review and cross-reference the fees with the standard allowed rate to avoid under-collecting. So you want to make sure that depending on what the insurance companies are paying, your standard fee schedule is not lower than that. And also consider insurance contract negotiations for enhanced reimbursement. I do quite a bit of negotiations with insurance companies, so that is available to practices to be able to go back to the insurance company and tell them that you are interested in negotiating your contract. And this way you could either do just straight across the board enhancement of your reimbursement, or you can do carve-outs. Certain surgical practices prefer to do carve-outs because certain procedures they would like to get paid more for instead of having E&M codes included in that. So it's something that everybody should consider if you have not done it or you have not done it in a while. All right. Denials management is the most important work in medical billing and the most overlooked, especially when you get to AR, which we're going to cover in a few minutes. But everybody's busy, everybody's trying to get their work done, and it seems rejections, denials kind of don't get worked as hard as they should. And a lot of times it's because the practice is not staffed enough to have enough people to work their denials and accounts receivable. But you have to be able to manage that with what you have and get as much money in from these areas. Top denial reasons: patient coverage not in effect at the time of service. Again, this would benefit checking, verifying benefits in the beginning at the front desk or when the patient first comes in. Coverage secondary to the patient, we mentioned also coordination of benefits, the incorrect patient name, date of birth, insurance ID, and timely filing. So there are certain insurances, Aetna, Cigna, United Healthcare are the 3 top ones that that I know. You have to submit your claims within 90 days. And saying that, some people will say, well, why would it take 90 days to get that claim out? But it happens, and it happens quite often. So you have to make certain that during those 90 days, particularly for those 3 insurance companies, that the claims get out. If they don't get out, there's no going back. You cannot get that money for those claims. Okay, next polling question.
All right, our fourth and final polling question. How often should coding and documentation reviews be performed? All right, 30 more seconds. Reminder, get your votes in. All right, 10 more seconds and I'll close it out. All right, I'm gonna close it and here are the results.
So the correct answer, it's actually a tricky answer here. The correct answer is annually, is based on the presentation. However, I would totally support quarterly audits being done in a practice. And I think that would be being extremely proactive. So I'm going to say those two are the ones that I would give you credit for there. Okay, I'm trying to build them. I'm not going. There you go. All right. So denial management, back to that. We talked about some of these already, but the service not being medically necessary. Obviously, then you have to provide notes and so forth to the insurance company to explain why the procedure or the service was medically necessary. Additional information requested. Usually that's either records or demographic information. The procedure doesn't match the diagnosis. It's inclusive to another service. This is where, you know, if you could use the 59 modifier, you would. Incorrect modifiers, the incorrect place of service, and medical documentation requests. Those are the key denial reasons. Sorry, I don't know what I just did there. Hold on. Did it again. Sorry. There you go. Okay. Rachel, can you go back a slide? Okay, thank you. So just as I just mentioned, accounts receivable is the biggest non-worked area. Again, if we're concentrating on collecting money up front, that will save a lot of money in the end in the AR. Concentrate on collections and denial management, which includes tracking rejections, denials, and unpaid claims. And also, as far as the rejections and denials, check to see if there's a trend. Are there certain rejections that you're getting over and over and over again? And if so, put a policy in place as to how that needs to be corrected up front prior to it coming back as being a rejection or denial. You need to have a strong management team to review the AR monthly, right? So otherwise, people touch AR here and there and it doesn't fully get worked and you leave a lot of money on the table. Review key performance indicators, KPIs, on a weekly or monthly basis, okay? And that's looking at different things as to, from the time of visit, how quickly does the claim go out? From the time the claim goes out, how quickly does it get paid? It also tracks rejections also and denials. Just anything within the practice that can affect it financially from start to finish is being monitored to make sure that you're meeting those indicators and that will increase your reimbursement as well. Review adjustment reports to confirm validity for the adjustment. There are some times I've been in practices and reviewed an adjustment report, and there are adjustment titles that you would have no idea what they are, and there's a large amount of money in there. And sometimes people would just write off things because they didn't know what to do with it. They didn't want to work the claim. I don't know what the exact issues were, but I have seen that in the past where there have been practices that had a lot of adjustments that were not necessary. So it's always good for somebody to review that and make sure that whatever adjustments are being done are correct. And then also you can always consider retaining professionals to perform a revenue cycle assessment. Someone coming in, starting from the front desk, going all the way through to denials and seeing what the current process is, and then making recommendations or observations to that. And best practices for denial management, keeping denials under 5%. Total accounts receivable should be less than 12%. And average days in AR should be under 45 days. So that's a goal for everybody. Those numbers are tight. So it's, you know, most practices would take a while to be able to get to those numbers, but it is very doable. And it also would be very beneficial for denial management. And I believe that is it. Oh, I lied. Okay, sorry. Additional ways to increase revenue. Optimizing your virtual appointments. So if a patient calls and they have to reschedule their appointment, the first thing you should say to them is, we can offer you a virtual appointment if you can still make it later today or tomorrow morning or something of that sort, just so that you're not losing that revenue if that patient decides not to come in again for quite a while. By offering virtual appointments, you may get them to schedule it that day. We talked about new patients and PAs operating at the top of their skill set. So making sure that they're able to do things other than, a lot of times I've seen practices would use a nurse practitioner or PA. I'm using a surgical practice as an example, but they would use them for their 90-day surgery follow-ups. But that's not bringing any money in. So trying to utilize them as best as you can, whether if they're working in a hospital or they're working in the practice, making sure that they're seeing patients and they're creating revenue. Manage your supplies inventory closely and reviewing vendor contracts and renegotiating costs. Believe it or not, most vendors will renegotiate the costs of their supplies. So it's something good to look into. And to build an online presence, increase through social media platforms, websites, advertisements, making sure, you know, that everybody knows that you're out there, what services you offer, and so forth. 72% of patients consult the internet for physicians, and 62% of patients research reviews for new providers. So this is where a lot of times, I don't see that so many practices do them anymore, but the patient satisfaction surveys go a long way. I mean, those are some things that you could, without putting, you know, necessarily the person's name up there, you can indicate what the reviews were. Obviously, it would be a positive effect to your practice. So if you put that on a website that you had, patients would be looking at that as well. Okay, we're done.
All right, we have a couple minutes left. Feel free to write in any questions that you may have. And if we don't have time to answer them, here is Tom and Maureen's contact information, and you also will receive a copy of this presentation as well as the recording. All right, I'm not seeing any questions come in. So thank you everyone for joining, and we hope you have a great day.